They thought they could bury this story. They thought if they kept their focus on cryptocurrencies and tech stocks, you wouldn't notice that something seismic is happening in the metals market. But the data is screaming now, and it's impossible to ignore. Silver just hit levels we haven't seen since 2011. And by the time you finish watching this, you're going to understand exactly why Wall Street didn't want you paying attention to this moment. This isn't a speculation rally. This isn't retail investors getting excited about shiny things. This is institutional money making a deliberate, calculated shift. And it's colliding with something far more fundamental that's been brewing for years. By the end of this analysis, you'll see the 6 converging factors that created a perfect storm. But more importantly, you'll understand the distinction nobody's talking about. Investment flows are driving the narrative right now, but it's the industrial fundamentals that are making this real, and that difference determines everything about what happens next. Let me put a specific number in front of you. As of December 23rd, 2025, silver broke through $71 per ounce for the first time in the modern era. That's not approximate. That's not wishful thinking from bulls. That's the actual price on actual exchanges, and it represents a 140 to 150% gain since the start of this year. Let me repeat that. Silver started 2025 at roughly $29 and is now trading above $70. The math requires a 140% move in 11 months. Now here's what you need to see before you dismiss this as a bubble. In the first half of 2025 alone, 95 million ounces of silver flowed into exchange-traded funds. Let me put that in context. In the entirety of 2024, only roughly 20 to 25 million ounces entered ETFs. So in 6 months of 2025, institutional investors poured in 4 to 5 times more capital into silver ETF products than they did in the entire previous year. The total value of those holdings hit $40 billion in June. $40 billion sitting in vaults backing physical silver. This is the institutional momentum we're talking about. This is not retail enthusiasm. This is serious money recognizing something and moving deliberately. But that's just the investment side. The real story, the one they definitely don't want you understanding, is what's actually happening with industrial demand. And this is where everything shifts from interesting to absolutely critical. The Silver Institute released its official data for 2024. Total global industrial silver demand reached 680 to 700 million ounces. That's roughly 60% of all silver consumed on the planet. Think about what that means. Silver isn't primarily a precious metal anymore. It's infrastructure. It's the thing that makes modern life function. Now watch what happened with solar panels specifically. In 2014, solar panels consumed approximately 11% of total silver demand. By 2024, that figure compressed to 29%. That's a 164% increase in solar's share of the market in just 10 years. And we're talking about 197 million ounces consumed by solar in 2024 alone. But here's the detail that changes everything. The technology is getting more silver intensive, not less. The industry shifted toward TOPCon and heterojunction cells because they're more efficient. These new designs require 1.5 to 2 times more silver per gigawatt than the older PERC cells they were replacing. So the industry didn't thrift silver consumption lower. It thrifted it wrong direction. Manufacturers went after higher efficiency, which happens to demand more of the one metal that's becoming scarce. That's not coincidence. That's the math of a market moving toward constraint. Add electric vehicles to the equation. A traditional car contains 15 to 28 grams of silver. A battery electric vehicle uses 25 to 50 grams. That's roughly a 70% increase in silver per vehicle. Now multiply that across millions of units. Global EV production is accelerating toward targets of 30 million units per year by the late 2020s. Do the multiplication. 30 million vehicles times 35 grams average silver consumption equals 1.05 billion ounces, just for EVs alone. That's more than global mine production right now. Then factor in electronics, medical devices, charging infrastructure, 5G networks, and the wild card that almost nobody was modeling 2 years ago, artificial intelligence data centers. A single AI server cluster uses 2 to 3 times the silver of traditional computing hardware because of power delivery and thermal management requirements. The Silver Institute estimates we've gone from essentially zero silver demand for AI infrastructure 5 years ago to potentially 15 million ounces annually in 2025, with projections suggesting 50 million ounces by 2030. These aren't speculative numbers. These are production run rates from factories that are operating right now. This is where the story transforms from interesting to impossible to ignore. Here's the fundamental math. Global mine production in 2024 stayed essentially flat at 819.7 million ounces. That's a 0.9% increase year over year. In a world where industrial demand just grew for solar, electric vehicles, and AI data centers all simultaneously, the supply response was effectively zero. And this isn't a short-term issue. 70% of silver mining comes as a byproduct from copper, lead, and zinc operations. Silver miners can't simply turn a dial and produce more silver. They're dependent on the economics of other metals. When copper is struggling, silver production struggles. That's a structural constraint nobody can overcome quickly. New silver mines take 10 to 15 years to develop from exploration to production. The projects that will meaningfully impact supply are being planned now for 2034 and 2035. There was a multi-decade gap between where we are today and when new supply can actually arrive. Meanwhile, the industrial demand is happening now. This year, this month, solar manufacturers need 200 million ounces annually. EV makers are ramping production. Data centers are being built. The demand is locked in. The supply is not. And that creates what we call a structural deficit. The Silver Institute confirmed this. 2025 is tracking toward the 5th consecutive year of supply deficit. The cumulative shortage from 2021 through 2025 reaches approximately 820 million ounces. That's equivalent to 10 months of global mine production simply gone, not allocated to other uses, not waiting in reserves, gone, consumed, used in manufacturing equipment that will sit in factories and vehicles for decades. Where does that silver come from? It has to come from somewhere. It comes from the vaults. This is where the investment story meets the fundamental story, and this is where you see the impossible happening. In April 2025, the gold to silver ratio reached 105.85 to 1. That means you needed 105.85 ounces of silver to purchase a single ounce of gold. By late December, that ratio had compressed to approximately 60 to 65 to 1. That's a 34 to 37% compression in the ratio in 8 months. Now, historically, the gold-silver ratio is averaged between 60 and 75 to 1. So what April showed us was extreme undervaluation of silver. What December shows us is something even more important. The market is beginning to price in that undervaluation. Investors recognized that silver was trading with a massive discount relative to gold, and they made a calculated decision. This is what happens in financial markets. When relative valuations become extreme, prices correct. But here's the critical distinction nobody is making. The ratio compression could happen two ways. Gold could fall, compressing the ratio downward, or silver could rise, achieving the same result. In 2025, silver rose 140 to 150%, while gold rose roughly 70%. This means the ratio compressed because silver outperformed. And silver outperformed because investors saw something in the fundamentals that made it compelling. They saw the supply deficit. They saw industrial demand accelerating. They saw the constraint becoming real, and investment flows followed. This is the exact opposite of a bubble dynamic. In a bubble, investment demand leads fundamentals. People buy something, price rises, and then we discover later that there was no substance. With silver, the substance was already there. Supply deficits had been running for 5 years. Industrial demand was locked in. The only thing missing was for institutional money to recognize it and act. And that recognition created 95 million ounces of ETF inflows in the first half of 2025. Let me map out exactly what aligned to create this moment. Factor 1 is the supply deficit that has persisted now through 5 consecutive years. You cannot have 5 years of demand exceeding supply and not see inventory depletion. The math requires it. Factor 2 is industrial demand that is fundamentally inelastic. Manufacturers cannot simply stop using silver in solar panels. They can't make EV batteries without silver. They can't build data centers without silver contacts and conductors. This demand persists regardless of price, up to a point. When you have inelastic demand meeting constrained supply, prices have to rise to reduce demand somewhere else. It's not an opinion, it's mechanics. Factor 3 is the recognition from institutional investors that the valuation mismatch was unjustifiable. Silver was trading at 105.85 times the price of gold, when historically the ratio sits at 65 to 1. That divergence got the attention of portfolio managers. They began rotating capital into silver deliberately. Factor 4 is geopolitical uncertainty creating safe haven demand. When central banks hint at rate cuts, when governments are running massive deficits, when trade wars are escalating, investors seek assets that can't be printed. Precious metals attract capital flows during these periods. Both gold and silver benefit, but silver benefits more because it has dual characteristics. It's both a safe haven and an industrial necessity. Factor 5 is the momentum that builds once institutional money starts entering. When you see ETFs receiving 95 million ounces in 6 months, other institutions notice. They notice the buying pressure. They notice the inventory getting tighter. They notice competitors positioning. This creates positive feedback. One institution enters, creating scarcity signals, which attracts the next institution. This is how momentum builds. Factor 6 is the shift in manufacturing technology toward higher silver intensity. Solar panels switch to more efficient designs that require more silver per watt. EVs are being produced in higher volumes. Data centers are running at capacity. This industrial demand wasn't forecast to arrive until the 2030s. It arrived early. The convergence of these 6 factors created something that shouldn't happen simultaneously, but did. And that's what moved silver from $29 to $71 in 11 months. Here's where I need to separate the signal from the noise, and this distinction matters tremendously for understanding the sustainability of this move. The investment flows are real. The 95 million ounce ETF inflows in the first half of 2025 are documented across multiple sources, including Silver Institute data, Bloomberg reporting, and fund filings. The $4.3 billion in SLV holdings growth is verifiable from iShares public reporting. The futures market net long positions that are now 163% above year-end 2024 levels are on the CFTC record. This is institutional money moving with deliberate intent. But let me ask you a critical question. Did those investment flows cause the supply deficit to appear? No. The deficit has been running for 5 years. According to Metals Focus research, we've had consecutive annual deficits since 2021, with industrial demand consistently exceeding mine supply plus recycling. Did those investment flows cause solar panel demand to accelerate? No. That demand is driven by government renewable energy mandates that are locked in policy. The EU targets 700 gigawatts by 2030. China is implementing massive solar capacity additions annually. India has binding commitments. These are political commitments backed by central government budgets. They don't reverse because a commodity got expensive. Did those investment flows cause EV production to ramp? No. That's driven by manufacturing capacity that has already been built and is coming online in 2025 and 2026. Automakers have capital commitments to battery production facilities. They're contractually obligated to supply vehicles to consumers. When a manufacturer signs a contract to deliver 1 million electric vehicles with 35 grams of silver each, that's 35,000 ounces of locked-in demand. It's irreversible. The investment flows recognize these fundamentals and allocated capital towards silver with recognition of the value opportunity. The fundamentals are the primary driver of the move. The investment flows are the amplification mechanism that accelerates the price discovery. Here's why this distinction matters for your understanding going forward. Investment flows can reverse. They're momentum dependent and sentiment susceptible. If sentiment shifts because of a market correction elsewhere, or if a major hedge fund gets forced to liquidate positions, or if the Fed changes course and signals higher rates for longer, capital can exit silver as quickly as it entered. That's a real risk we have to acknowledge without minimizing. But fundamentals are sticky. They don't reverse unless the underlying economics change. A solar panel manufacturer who signed a contract to build 500 gigawatts of capacity by 2027 cannot suddenly change their mind because silver got expensive. They're locked into that production path. They'll pursue efficiencies, they'll implement thrifting, they'll optimize designs, but they can't walk away from the commitment. The same applies to data center build-out and EV manufacturing. These are capital-intensive paths that create multi-year locked-in demand. So when people ask whether this is a bubble, the answer is only the investment portion could be accurately called speculative or sentiment-driven. The fundamental portion, the 680 million ounces of annual industrial demand, growing at 5 to 7% annually, is real, structural, and expanding. The fact that investment flows are amplifying prices doesn't negate that the underlying fundamentals are structural. It means that when sentiment shifts, we might see volatility and pullbacks. But we won't see a return to $30 silver without a fundamental shift in industrial demand. And the fundamentals are accelerating, not decelerating. Let me take you behind the numbers that should terrify anyone focused on supply chains. The Silver Institute tracks what's called available mobile inventory. This is the silver sitting in vaults that can actually be moved, sold, or allocated to new buyers. In 2019, there was substantial mobile inventory. Companies could source silver with reasonable lead times. As of late 2025, after 5 years of deficits totaling 820 million ounces, that mobile inventory has been depleted dramatically. The refineries report capacity constraints. The major vaults report allocation challenges. Some dealers have removed the buy buttons from their websites. This isn't speculation or exaggeration. Dealers in the United States have reported customers requesting delivery of bars they purchased in late 2024 and being told that shipments will be delayed 6 to 8 weeks. That's what constrained supply looks like in real time. The COMEX silver warehouse inventory, which is supposed to be the backup supply for futures contracts, has been declining. In late 2024, registered inventories stood at higher levels. By December 2025, the registered category had contracted significantly, signaling that metal is being drawn down faster than new supplies are arriving. Now layer in the fact that industrial users, the manufacturers we talked about, cannot afford delays. A solar panel factory cannot shut down production lines because silver is on backorder. An EV battery maker cannot miss delivery commitments to automotive partners because paste suppliers are out of stock. A data center operator cannot defer construction because thermal management materials are allocation constrained. These aren't theoretical scenarios. These are specific production timelines with contracted penalties for missed deliveries. This creates a hierarchy of scarcity. Industrial users with contracts and production schedules move to the front of the queue. Speculators and retail investors move to the back. That's not conspiracy. That's the actual functioning of supply chains under constraint. When supply tightens enough, price has to rise to the point where marginal demand, the least critical uses, stops consuming. We're seeing evidence that we're approaching that level. When the gold-silver ratio was sitting at 105 to 1 in April, it was basically saying silver was so cheap that industrial users couldn't justify switching to substitutes. But at 65 to 1, and with prices now above $70, manufacturers are actually beginning to pursue alternatives. Some solar companies are experimenting with copper-based contacts instead of silver. Electronics manufacturers are looking at various substitutions. Some EV battery makers are researching alternative conductive materials. But here's the critical constraint. These transitions take time and they sacrifice efficiency. A copper contact doesn't conduct electricity as well as silver. It doesn't have the same thermal properties. It requires thicker application, which adds cost and reduces efficiency. So manufacturers can reduce consumption by 10 or 20% through process improvements and engineering workarounds. But they can't eliminate it. This is the constraint of physics and chemistry. Silver has properties that are essentially irreplaceable in many high-performance applications. You can reduce consumption by implementing thrifting strategies, optimizing metallization patterns, and adjusting cell designs. Historical data shows the solar industry has already achieved roughly 30% silver intensity reduction over the past decade. But you cannot reduce by 50% without fundamentally changing the technology architecture. And that transformation requires multiple years of R&D, validation, pilot production, and scaling. It's not something you do in response to a temporary price spike. It's something you do if you commit to a new technology platform. The current environment isn't pushing that level of commitment. It's pushing marginal efficiency improvements while maintaining existing technology. That's the constraint we're dealing with. This is the critical insight that explains why silver is behaving so unusually right now. Normally, when you have a commodity that experiences strong fundamental demand, the price rises gradually over time as the market adjusts expectations. The process is slow, but when you combine that fundamental demand with investment flows that have been dormant for years, something different happens. The institutional investment community sees both the fundamentals and the relative valuation opportunity. They see the gold-silver ratio at 105 to 1, which is outside historical norms. They see supply deficits continuing. They see industrial demand accelerating. They see, all at once, that the previous price level at $30 to $35 for silver was unjustifiable, and they move. Once they move, they create scarcity signals, inventory declines, premiums widen, dealers report delays. Smaller investors notice these signals and demand accelerates. The feedback loop amplifies. This is what we're seeing. The momentum phase and the fundamental phase are synchronized. They're moving in the same direction. That's rare. Normally, those phases are separated by quarters or years. The lag between when fundamentals shift and when investment flows recognize them creates gradual price appreciation. But with silver, the lag compressed. The investment community saw the fundamentals and reacted faster than historical norms. This compressed the timeline for price discovery. And that is why we've seen 140% gains in 11 months instead of the same gains spread across 5 years. Both outcomes, the fast version and the slow version, would be justified by the fundamentals. The fast version is happening because momentum recognized the opportunity more quickly than typical. You're going to hear arguments against this analysis, and I want to prepare you for them so you can see them clearly when they arrive. The mainstream will tell you this is a bubble driven by irrational enthusiasm. They'll point to the extreme gain and say asset classes that gain this fast always crash. They'll reference historical bubbles in cryptocurrencies and tech stocks and imply silver is the same phenomenon. But here's what doesn't fit their narrative. In cryptocurrency bubbles, there is no underlying industrial consumption. Bitcoin doesn't actually do anything. Its value is purely speculative and psychological. With silver, you can point to 680 million ounces of documented, contractual, locked-in annual industrial demand. You can point to specific factories building specific products that require specific amounts of silver. You can audit the supply deficit. You can verify the inventory depletion. This isn't mystical, it's traceable. The mainstream will also argue that higher prices will destroy demand through substitution. And they're technically correct, partially. Substitution will occur at the margins. Some solar manufacturers will shift toward less silver-intensive designs. Some electronics makers will find alternatives, but the thesis assumes that substitution can be rapid and large-scale. In reality, substitution requires R&D investment, process redesigns, supply chain recalibration, and validation testing. These timelines are measured in years. Meanwhile, the production capacity already built is designed around silver-intensive manufacturing. A solar panel factory doesn't simply swap out its process because silver got expensive. It runs the product it was designed to run. This takes time to change. So yes, substitution will reduce demand from 680 million ounces to perhaps 620 or 600 million ounces over time. That's a material reduction. But it's not the kind of rapid demand destruction that would crash the price back to $30. You're also going to hear the argument that supply will expand to meet price. And technically, that's how markets work in the long term. But we're not in a long-term scenario. We're in a 10-year window where most new mine supply is locked out by project development timelines. The supplies that can arrive by 2030 are already in development or permitting. Companies making investment decisions today will produce metal in 2029 and in 2030, but the deficit is happening now. That gap between when the deficit exists and when new supply can arrive to close it is years long. That's the window we're in. If the fundamentals hold, if industrial demand doesn't collapse, if supply continues to grow slower than demand, if the deficit persists, then the supply constraints are going to force continued price appreciation. Not smoothly. There will be pullbacks and volatility. Investment flows are momentum dependent and sentiment can shift. But the direction, if fundamentals remain intact, is constrained by supply. The math requires prices to rise to reduce demand at the margins until supply and demand equilibrate. That equilibrium point, based on current industrial demand trajectories and supply projections, is substantially higher than $70. Analysts differ on specific targets. HSBC projects prices in the $45 to $53 range for average 2025 pricing, though that analysis predated the December surge. More recent analysis from Metals Focus following the historic run suggests $60 to $80 sustained levels are justified by fundamentals alone. The consensus in the institutional investment community points toward $100 to $150 per ounce by 2027 to 2028, if industrial demand continues accelerating as expected. This isn't a certainty or a guarantee. This is a baseline scenario that flows from the fundamentals we've documented. The probability distribution includes outcomes where prices range from $50 all the way to $200, depending on how industrial demand evolves and how quickly substitution occurs. But the bottom end of that range, prices falling back to $35 or $40, would require demand destruction. It would require solar manufacturers to stop building panels. It would require EV makers to shift back toward traditional gasoline vehicles. It would require data center operators to stop building new facilities. It would require the entire energy transition to reverse. That's not a scenario the data supports. The bear case doesn't rest on supply expanding. Supply cannot expand fast enough to create that outcome in the near term. Supply expands over decades, not months or years. The bear case rests on demand destruction, and demand destruction would require exogenous shocks, economic recession so severe that manufacturing stops, government policy reversals on renewable energy mandates, technological disruption that suddenly makes silver unnecessary. Those are possible, but lower probability scenarios. The base case is that fundamentals remain mostly intact, deficits persist, and prices move higher. There are risk scenarios where industrial demand slows due to economic contraction, where government policy suddenly subsidizes silver substitutes, or where operational breakthroughs suddenly make major new mines feasible decades faster than current projections. In those scenarios, prices could consolidate or correct. But the bear case still rests on demand destruction, not on supply expansion. Supply cannot expand fast enough to create a crash outcome in the next 2 to 3 years. This is why the distinction between investment flows and fundamentals matters so much for risk management. The investment flows can reverse, creating volatility and perhaps a correction of 15 to 25%. That would be normal for a commodity in a bull market. Those corrections are opportunities to rebalance positions. But a 50 to 70% crash back to $40 would require industrial demand to suddenly disappear. And there's no mechanism that would cause that sudden disappearance. Solar panel production isn't slowing. EV manufacturing isn't slowing. Data center build-out isn't slowing. These industries have government mandates, consumer demand, and capital commitments backing them. They're locked in. So the floor for silver prices, if fundamentals persist, is probably somewhere around $50 to $55, even in moderate recession scenarios. The ceiling is indeterminate based on how high prices need to go to produce enough demand destruction to balance supply. At $150, does jewelry demand drop? Probably substantially. Does some industrial substitution accelerate? Does investment buying cool because people think the asset is overvalued? Definitely. Those mechanisms could balance supply and demand at elevated price levels. We don't know the exact equilibrium, but we know it's higher than $70 if the deficit persists. The concrete fact is this: Investment flows into silver ETFs have surged to 95 million ounces in the first half of 2025, representing a 4 to 5-fold increase versus the entirety of 2024. This is documented. The industrial demand is real. Solar panels consumed 197 million ounces in 2024, and that percentage of total demand is growing. Electric vehicles are ramping production and require 70% more silver than traditional cars. Data centers are demanding silver for power delivery and thermal management. These are facts you can verify. The supply deficit is structural. 5 years of consecutive deficits totaling 820 million ounces, our historical record. Mine production is growing at less than 1%, while demand is accelerating. That's also a verifiable fact. The valuation divergence was extreme, with the gold-silver ratio reaching 105 to 1 when the historical average is 65 to 1. That compression to 60 to 65 to 1 represents rational repricing by institutional investors. This is the scenario playing out. Investment flows are amplifying the move, but fundamentals are driving it. You now have the information to form your own perspective. You can see which factors are structural and which are momentum dependent. You can distinguish between the parts of this story that can reverse quickly and the parts that are locked in through production contracts and capital commitments. That distinction matters for how you think about the next 18 months, not as prediction, but as probability distribution. The probability of silver continuing higher is supported by structural fundamentals. The probability of volatility is real because investment flows can reverse. Understanding both is how you navigate this inflection point with clarity rather than emotion.